Have you ever thought you could outsmart the market by selling your business at the very, very frothy peak of the summit? Well, my sweet summer child, you cannot. But here's the thing, you can actually time yourself when it comes to exiting your business. So let's talk about why you can't time the market in M&A and how you can time yourself for a maximum exit in the shortest possible time and the easiest transaction you can do when it comes to selling your business. Let's get into it. Okay, so I have helped sell over 2,000 businesses now on our marketplace. And this is a very common question, whether I'm in a Facebook group, in a community, or if I'm at a conference giving a presentation. People come to me all the time, whether in person or in my DMs, asking me, Greg, when is the right time for me to sell my business? When is the right time for me to make an exit? And this is a big question, right? We are talking about your entire net worth, basically, as an entrepreneur. If you're like most entrepreneurs, your business probably makes up roughly around 70 to maybe even 95% of your entire wealth. So this is a big decision not to take lightly when it comes to selling your business. So it makes sense people want to know when's the right time to sell. So let's talk about it. Why market timing for M&A doesn't actually work. So this is the thing you need to think about. When you're thinking about the stock market, when you think about the real estate, housing market, all these big things, that's macroeconomics. When it comes to small business M&A, we're really talking about microeconomics. And let me ask you a question that will kind of prove my point. What did you do last week? What did you do 2 weeks ago? What are you going to do next week? What are you going to do 2 weeks from now? If you're like most people, you might have a vague idea what happened 2 weeks ago, unless you like really wrote it down or something amazing happened or something bad happened. Our bad memories tend to stick with us more, right? But when it comes to predicting the future and even remembering what happened in the past, we're pretty bad as creatures when it comes to this type of thing. Now, let me ask you another question. What will the S&P 500 do 3 months from now? What will the housing market do in 3 months from now? The truth is, no one really knows. Maybe there's some like best guesses, especially with the housing market that tends to be a little bit slower moving, but S&P, who knows? Who knows what's going to happen? And that's just 3 months. Like an average M&A transaction could take a year. So if you were trying to sell your business, especially if it's a 7-figure business, an 8-figure business, you are in it for the long haul. Like if you look at the average time to sell once you're listed on our marketplace, it's roughly around 90 days. But it's really closer to 120 days because when you do submit your business to sell with us, it has to go through our vetting process. And that takes anywhere between 1 to 4 weeks for us to make sure everything is good and we dress it up nicely for the buyer to look at, all that fun stuff. So we're looking at 120 days on average with our marketplace, and bigger transactions, I know, can take sometimes 8 months to even 14 months. So when it comes to M&A, these are complex transactions that can be slow moving. Now, the paperwork is actually pretty simple. Like I think it's much easier to buy or sell a business than it is to buy or sell a house in terms of the actual like paperwork legalities of it all. But when it comes to selling a business, it's a slower transaction because there's just a lot more moving parts you have to go through when it comes to negotiations. So this timeline right here shows you why you can't really time the market. Now, you can time the market in the sense of timing yourself. And what I mean by that is something known as a S-curve, this. Now, before we get into the S-curve though, let's talk a little bit about what I mean by microeconomics. So when it comes to microeconomics and macroeconomics, macro is going to be things like the S&P 500, it's going to be things like the real estate market, the overall general GDP of a country. This is what I mean when I'm talking about macroeconomics. When I'm talking about microeconomics, I'm talking about the business you have built that has a strong positive cash flow. Because your business is pretty detached in most cases. There's probably some exceptions to this rule, but generally it's detached from the earnings of the public markets. So if your business is growing by 80, 100% year over year, most buyers are not going to really care that the Tesla stock price fell by a massive amount because of some tweet Elon Musk did on X, right? That's usually not going to be an influencer when it comes to actually selling your business and timing in the market. And that's one of the most beautiful things about running your own business is this asymmetrical bet. You can create a business that outperforms the market dramatically if you know what you're doing. This is why a very common saying in entrepreneurship is the best investment you can make as an entrepreneur is in your own business. Because you could put $1 into those meta ads and get $5 out, that's certainly going to be better than almost any kind of dividend stock you could ever invest in. Not investing advice, but that is my general observation. And unlike the stock market and to a lesser extent the real estate market, you have a lot more control over this than any other kind of investment. You can't really do much to affect the GDP on a national scale, but you sure can do a lot for your conversion rate, for your profit margin, for your cash flow, and even your revenue growth. These are all reasons why businesses themselves, they are more microeconomic than macroeconomic. So when you're doing an M&A transaction, keep that in mind. You're operating on a microeconomic scale where the larger market, whatever it's doing, doesn't really play here. Like the market could be really, really frothy and everyone's making a bunch of money, but if your business is declining, it doesn't really matter what Elon Musk is doing for you, right? So you can't time the market in the traditional sense of how people think about timing the market. Now, with all that said, there is a caveat here that does come into play when it comes to selling your business, and that is interest rates. Interest rates are going up right now. They're kind of stagnating. They're not like shooting up at the moment, at least not yet, as recording of this video, knock on wood. But this does affect you if you are an entrepreneur that has a multiple 7-figure or 8-figure business. Now, the reason why it affects you at those price ranges is because the people buying your business most likely are going to be private equity, family offices. It could still be an affluent entrepreneur or even a strategic, which is fantastic. But in general, these are the type of people that tend to raise money. They raise equity capital and they raise debt capital. And debt capital is where the wrench is thrown into all of this. Is the one area where macroeconomics could affect your deal. And that is because the cost of getting that capital, the cost of getting that debt is now much more expensive than what it used to be. The last, 10 years or so, we've been operating at a pretty flat interest rate where capital was kind of free. And now that is not the case. We are moving into a more stringent economy in that sense, and that will affect you because that will make buyers probably give you a lower offer to offset the interest that they have to pay on the debt that they acquired to acquire you. So that's one area where macroeconomics will affect you in your transaction. But if you're an entrepreneur that is selling, say, a $500,000 content site, then even this doesn't really matter. Because at that range, if anything less than $1 million in terms of your sales price, in general, there's not going to be any equity raise and debt raise. It can happen, don't get me wrong, but it is very unlikely. Typically, any deal, especially under $500,000, we're going to see all cash offers win the day still with a bit of seller financing in there, but that is completely divorced from the interest rate markets at large, so it will have no real bearing on you. Here's the thing, buyers will buy your business in a up market when everything's frothy and valuations are way, way, way up from the demand, and they will buy your business in a down market when everything's looking pretty doom and gloom. Buyers typically don't deploy capital though if they're going into an uncertain market, which is often what we have been seeing. Like at the start of COVID in 2020, there was a lot of uncertainty for the first quarter, and we had some of our worst transaction volume ever in our company history. Now, everyone has a COVID hangover, and we're transitioning into this higher interest rate market. So any market in transition is a market in uncertainty, which does make it harder for you to sell a business. So that is the second part of the macro that can affect your business. But those are the main two things: debt interest rates and uncertain markets. Now we are slowly getting out of the uncertain market and buyer volume has come back, which means it is a good time again to sell your business. And in fact, though it's not as frothy as 2021 and 2020, selling your business in 2023 is still the second best time, 2024. I already forgot it's 2024. Selling your business in 2024 is the second best time for you to sell your business based on the multiples that I've seen. It's certainly significantly better than 2019, but with all the doom and gloom talk going on across social media, you may not even realize it. So you might think right now is a terrible time to sell, but in fact, it's the exact opposite. All right, so I promise you there was a way to game the system, so to speak. And there is indeed a way to do this. And it has nothing to do with the market in general, because remember, that's macroeconomics and we're talking about microeconomics when it comes to exiting your business. And the way you do it is looking at your profit and loss statement. So as long as your business is showing year-over-year growth, a healthy amount of positive cash flow with good margins depends on the business model, but if you're in a service-based business, usually 15 to 20% margins is considered very good if you're above 7-figure valuation. If you're in e-commerce, you're looking more at 20 to 30% margins. If you're in a digital product business, obviously it's going to be much higher, or a SaaS much higher. But these are some margins for you to shoot for when it comes to selling your business with your P&L. Your profit and loss statement is kind of the story of your business, the narrative of your business. You want to be telling a good narrative. And ideally, you want to be talking about a growth narrative. Now, when I say growth narrative, I am not talking about revenue. Revenue is, in my view, kind of a vanity metric, which a lot of entrepreneurs don't like to hear about. I have a whole video coming out about that exact topic next week. So if you haven't subscribed, make sure you do. Help my engagement, helps my marketing KPIs too. And you want to do that. Anyhow, so when it comes to your profit and loss statement, what we're looking for is that S-curve right here. So this S-curve is a very common thing that you might have already experienced it multiple times in your business. It's not just a one and done thing. Typically how this S-curve works is you invest heavily into your business, so your profit goes down like this, and then that investment you did pays off and it starts going like this. And eventually you're going to reach this peak right here, you're at the very top, and most sellers think that's when I'm going to sell, but that is the wrong move. You can sell there, don't get me wrong, we've done it many times, but that is not the place to sell if you're trying to time the market. People always think you should sell at the top, and while that's true in real estate and stocks, it's not true when it comes to selling your business. Because what do buyers want? What are the buyers buying when they acquire you? They're buying growth. They want cash flow positive growth. They don't really care about revenue, especially right now. They want things that are strong, positive cash flow. That's how you beat the macroeconomic market, by buying businesses with strong, positive cash flow. This is why revenue is mostly a vanity metric unless you're doing like a Silicon Valley style exit. But with all that said, if you wait until you're at the top of that S-curve, that means that peak will quickly become a valley. Every time we grow our business and scale our business, we always have this moment spurts of growth. Then we have this peak right here that becomes a valley. And during that valley, we have to pivot. We have to grow our business. We have to tweak our system. Sometimes rebuild the entire business almost from scratch. This is when you might have to hire someone from the outside that is the grown-up in the room who actually has like real CMO experience or CEO experience, or whatever it is, right? So you have to retool your entire business and start thinking about it differently to turn that peak that went to a valley back into another S-curve. And you're probably going to go down deeper into the valley before you go to that next S-curve. So when it comes to selling your business and timing the market, if this is the S-curve, you want to sell right in the middle of that growth curve. Because what that will do, one, the buyers clearly see the growth. It's happening before their very eyes. It's clear it's not going to slow down. This creates FOMO, fear of missing out. Every day the buyer doesn't acquire you, they are missing out on that growth that they could have had on their capital. We had a business that went, it was growing month over month very aggressively, and the buyer kept saying like, I'll wait till next month. Like he was trying to whittle the seller down. Like the seller was going to get tired and sell it to me for cheaper, right? But that didn't end up happening. In fact, that buyer waited 3 months, and the seller waited 3 months just as hard as the buyer, and that buyer ended up buying that business for a significantly higher price than he could have gotten it 3 months ago, because it was on that S-curve, that growth curve. It's so important. So if you want the best possible multiple for selling your business, you want to sell on the S-curve, not at the top of the S-curve, but right in the middle of the growth curve of the S-curve. That was a lot of curves, sorry. But this is in general how you can sell with the quickest time frame, smoothest transaction, and this is one time where leaving money on the table is actually a good thing. I have a friend, he's actually very well known in some circles in the marketing world, and every time I've tried to sell his business, you'd think that this guy would have the most amazing business for me to sell. It was always such a slog. And the reason why it was such a slog is because he was too good. He optimized the entire business to the nth degree. So when a buyer was looking at buying this guy's business, like, well, I don't know what to do with this. It's all like, where to go from here? You already reached the ceiling, right? So it had to be a creative buyer to even acquire the guy's business in the first place because of how well optimized it was on all things. Now, when you go to sell your business, it's okay to leave money on the table. In fact, it's preferable because that is how you're going to get buyers interested. The money you're leaving on the table is the opportunity for that buyer. And you can increase that opportunity massively if you sell on the S-curve. And that, my friend, my dear viewer, my sweet summer child, is that you sell your business at the right time for the maximum exit. So all that being said, if you're ready to sell your business, you can always click the link below and get a free valuation from us, or, help out my self-esteem and give me a like on this video. Talk to you guys soon.